Hey guys, this is Jose Baeza with eFunding Experts, and before we get started with this video, I want to ask for your help to support our channel. Go ahead and click on the subscribe button. We'll be sharing way more videos, and it would really help us out. So this topic for this video is how do lenders evaluate your credit report? Okay, and see, one of the biggest things that when it comes to getting access to loans or even credit lines, it becomes a little bit of a hassle sometimes because we're not really sure as consumers as to what lenders are actually looking at, right? Especially nowadays with COVID, there's so many things that lenders are looking at as to how to eliminate some of their risks on their end because they know that some people may not have jobs or maybe their credit took a bit of a hit, and so it can be very confusing. But hopefully this video is very helpful for you guys so that you can learn a little bit more as to what lenders look at when they're evaluating your credit report. So to get started, first, let's take a look at the three credit bureaus that are out there. We got TransUnion, we got Equifax, and then we got Experian. Now, out of those three, usually the most important one tends to be Experian, and then TransUnion and Equifax are there, right? But the thing is that when you're looking at a credit report, it is important to look at all three credit bureaus because some lenders may or may not look at all three bureaus. And if you've ever looked at your credit report, which again, you can actually look at right now, there's a lot of credit cards that are giving you access to your credit report. But keep in mind that even though you're getting access to your credit reports through credit cards or even just Credit Karma or some of these other free credit bureaus type of websites, you want to be very careful because they are not giving you always the full spectrum of your credit report. Okay, so if it makes any sense for you, keep in mind that whenever a lender is looking at your report, they're not going to look at Credit Karma. They're not looking at their credit card statement type of bureau or website. They're actually looking directly at the credit bureaus. So one of my biggest suggestions is that if you really want to look at how your credit is right now, I would recommend going straight to the source. Go to one of their websites. There's a lot of good websites out there as well that you do have to pay in order for you to have a membership and be able to see your report. And I would definitely say that it's well worth it because you do not want to go into a situation where you're inquiring about loans or credit cards only to find out that your credit score is not where you thought it is. And that happens very often. Where especially with some clients of mine, they'll say, you know what, Jose, I have a 750 credit score. I know I'm good. But then what happens is that when we actually look at the true bureau's report, we see that it's only a 650 or it can be way off. The reasons why they can be way off is because there are certain accounts that may or may not be up to date. Maybe perhaps they have not been updated yet to the bureaus or even just to the credit card statements because, again, these are free services. Therefore, because they are free services, have you ever guys heard you get what you pay for? Or if you're not paying for it, it can be very challenging. It could be a hit or miss type of situation, and you do not want to go inside a banking institution or a credit card or a loan application thinking that you have something that you don't. So having said that, definitely go straight to the source to get a copy of your credit reports. One of the things that you want to also look at is lenders are going to evaluate your debt to credit ratio, okay, and also your debt to income ratio. Now, those two are very important. Your debt to income ratio will determine how much of a loan can you afford. So that's what a lot of lenders look at when they're trying to evaluate whether you qualify for a mortgage or even if you qualify for another loan. So one of the best ways for you to make a calculation as to where you are at with your debt to income ratio is basically add up all of your expenses and then add up your income. And by doing a little math, you'll be able to see where you are at. Now, here's the thing. You want to be below 40%. Debt to income is a little bit more lenient than debt to credit. Now, debt to credit is similar in a way, but the biggest difference is that you want to add up all of your credit cards and then you want to add all of your credit card debt. So by adding all your credit card debt and your credit cards limits, then you'll get to do a little math and then be able to see where you stand within your credit card limits, okay, and your debt to credit ratio. And think about it like a 10-30 rule or 10-3 rule where you don't want to use more than 30% of what you have available. Okay? So it's a little bit messed up. Trust me, I get it. It does not make sense in a way because you're getting access to all this credit, but yet you can't use it. And if you use it, you end up getting a hit on your credit score. So here's how it works. Let's think about a credit card that you have $10,000. Well, if you have $10,000 in the credit card, some of us may think like, well, I can go and use the $10,000 credit cards, right? Wrong. Here's what happens. If you use over $3,000, which is 30% on that $10,000 credit card, then it's going to start to take a toll on your credit score and your credit report because it makes it seem like if you're depending on your credit alone in order for you to sustain your lifestyle or whatever you want to call it, right? Your business, anything. So the thing is that when it comes to your debt to credit ratio, it does take a little bit of a hit if you go over the 30% mark. Now, there are certain rules where there's a bit of an exception on that, right? And the exception is that there are credit cards out there, business credit cards in particular, that don't report to your personal. That means that if you have a $10,000 business credit card and it's not reporting on your personal credit report, then you're better off using that. And yes, you can use the full $10,000 without having an effect on your personal credit report. Okay. So that is a great thing about business credit cards, business credit, that it allows you to be a little bit more flexible, and it definitely allows you to use way more of that available funding for you without having to take a toll on your credit. Now, having said that, one other thing that lenders look at is your inquiries. Now, there's two types of inquiries. There's soft pull. Well, actually, I'm sorry. Those are two different things. But inquiries are what comes from a hard pull, okay? And a hard pull is when a credit institution or maybe a lender or maybe even just a dealership, if you're going out to get a car or a mortgage, what they'll do is they'll actually do a hard pull. And they'll pull your credit as if you're applying for that loan and you're ready to go, right? So what happens is that they'll go ahead and take a look at your entire bureau, your entire credit report. And when they look at your credit report, then it's going to have a mark on your credit report. When it has that mark, that's what's considered a hard pull. That hard pull, however many hard pulls you'll end up getting, usually more than 4 will start to take a hit on your credit score and your credit report because it makes it seem like you're desperate. It makes it seem like you're actually going out there and you're applying, and it doesn't make you look good. So therefore, it's gonna hurt your credit. That's why whenever you're going out to get a car loan, it is always better for you to get a pre-approval from a lender or maybe even one of the crowdfunding lending institutions that are out there right now, because they'll do what's called a soft pull. Okay? And a soft pull is similar to a hard pull. The only difference is that it doesn't make that mark on your credit, so therefore it doesn't affect your credit. And that's the one thing that we specialize in raising capital, is that we want to get you first the soft pre-approvals prior to doing any hard pulls. Because when we do the soft pre-approvals, there's way more opportunity out there, especially if we're raising capital for one of our clients. We can negotiate the loan, we can go ahead and talk to the underwriting department, and we can see if we can increase that amount, or we can simply go ahead and figure out other avenues that we may have to take in order to get the desired amount without having to hurt your credit. Most of our clients are way over 700 credit scores, and therefore their biggest priorities is for their scores to stay intact as much as possible. Now, is it possible for you to get a loan without having a hard pull? Not necessarily. It is very rare. You would have to do a business loan, a true business loan, in order for that to happen. But nowadays, especially with COVID, you're typically having to do a personal guarantee, which again will require a hard pull. But the good thing about this is that you want to get access to your pre-approvals. You want to get access to all of the amounts that you can possibly get without having to do a hard pull. So you want to stick to soft pulls as much as possible. When you go and apply online via credit card, that's a hard pull. And that's why sometimes when we apply on credit cards, they won't tell you that you got approved. They'll just go ahead and say, hey, we'll contact you. We'll reach you via mail. Because again, you got denied, but it's a nice way sometimes to go ahead and say, hey, you didn't approve. It's not always the case though, because again, when you're applying for business credit, they will have to obviously do their due diligence, and sometimes it takes a little bit longer, so that's why. But having said that, you guys, one other thing that they're going to look at, that the lenders are going to look at, is the type of accounts that you have. Now, many of you guys are familiar with authorized users. The only thing is that with authorized users, you're not the actual account holder. You're just an authorized user on that account. And many lenders are not necessarily considering those as true credit lines for you. So whenever you do have an authorized user, depending on what type of lending or what type of funds you're going after, they may not consider those as accounts that will help you. They may actually hinder you. And one of the ways that is going to happen is that they'll add up all of your accounts. They'll take a look at all the type of accounts that they'll do that you have available. And if you have a certain number of accounts that, let's say, are authorized users, let's say you have 5 accounts, right? If you have 5 accounts and only 2 are actually your accounts and 3 are authorized users, the 3 may be the ones boosting your credit scores. And if they're the ones boosting your credit scores, what these particular lenders will do, they'll eliminate the 3. So they are not going to count the 3 that are authorized users. They'll only count the 2. And then now you're looking more towards your debt to credit ratio may go up. Your debt to income ratio may go up. And therefore, you're not going to get approved for that particular loan. Now, there are exceptions to it, as I mentioned. One of the biggest exceptions is that, for example, with our hard money lending or even just some of our real estate lending, what we primarily look at is the score. Okay. Now, the score is what we care most about. So that means that if these 3 authorized user accounts are bumping your score up, making it seem like you have more credit than you actually do, then we don't necessarily care too much as to whether they're authorized users or not. We just care about the score. So as long as the scores are good, way over 640 credit score typically, then we should be able to get you access to funding. Now, obviously, it's all going to be in a case by case, because real estate lending is not always based on credit, it's more based on a deal, right? So the deal has to make sense. But having said that, that would be another video to discuss. And, one of the biggest things that you want to always consider is that you have to be very careful when paying for authorized user accounts. There are lending institutions out there, or even just credit restoration companies that are selling authorized user accounts. So again, you want to do your research first to make sure whether this is going to be a good option for you, because if you are trying to get let's say a line of credit or some credit card funding, or perhaps maybe term loans, the authorized user accounts are not going to help. But if you're trying to get real estate funding, then that may actually help you. But keep in mind that some of those authorized user accounts that are being sold out there or that are being offered, they can be very expensive, in the thousands sometimes. So you just want to be very careful. So one of the best ways to inquire for funding is, like I mentioned, you want to go ahead and get access to the pre-approvals. You can use a company like ours, for example. We can go ahead and provide you a copy of all the different offers that are on the table without actually going ahead and inquiring or doing a hard pull. So you'll get to see the offers before you even get a hard pull, which is very important. And one of the best ways for you to get access to, let's say, $200,000 or more is by having a much lower utilization on your debt to income, which is less than 40%. and keeping your debt to credit ratio at less than 30%. So you want to stay below those two numbers, because again, it's going to make it seem make it seem very convenient for you. But as long as you also have some income coming in, the income doesn't necessarily have to be for business, but it could be personal from a job, retirement, anything that shows that you can afford another loan. That's typically very helpful. So if I missed anything, you guys, there's way more that lenders are going to look at when evaluating your credit, but those are the primary reasons as what they see. On another video, we'll actually go ahead and go over some of the accounts that are positive, some of the accounts that are not so positive, that can be actually a negative to see on your credit report. But for now, as long as you take a look and you consider those options that I just mentioned to you, you should have a really good chance of either getting approved for a loan, or at least taking a look as to whether getting a loan or getting a credit card or any type of credit line might be a good solid offer for you, for a good solid step, so that you don't hurt your credit. Because again, credit right now, is in today's day and age, is very important, right? So if I missed anything, you guys, go ahead and leave that on the comments. We will be doing way more episodes where we go more into detail on these topics, and I'm very excited to share this information with you guys. So again, this is Jose Baeza with eFunding Experts, and be sure to subscribe to our channel for more information, for more videos, and I will talk to you guys soon. Thank you.